This holiday season, we're helping you catch up on all your favorite FreightWaves TV shows. You can now watch the latest freight news, market insights, and in-depth discussions on your preferred streaming platform. As our gift to you, if you purchase a FreightWaves Live Atlanta ticket from now through December 18th, you'll receive a free Apple TV 4K. Download the FreightWaves TV app today and you'll see freight has never looked this good.
That means another week of FreightWaves Now. My name is Anthony Smith. I'm your host for today, and we have an awesome lineup for you today. We have Luke Falasca making his return, talking to the brokers. I'm stepping in for an Econ shipper update, but first, a word from Zach Strickland on a carrier update, sponsored by Powerfleet. Stay tuned.
Hey everyone, and welcome to your Monday Carrier Update. I'm Zach Strickland, so let's dive right on into what's happening in the freight market today. Behind me, I've got the outbound tender volume index with the outbound tender rejection index. The outbound tender volume index is starting to slide down off of its peak, which happened right around Thanksgiving and the holidays, something we anticipated a little bit of. Still about 4 to 5% better than this time last year, but we're seeing that contraction effect. You know, there's not as much time between Thanksgiving and Christmas right now. So there's still a lot of elevated volumes even with that being said. But tender rejection rates starting to really pick back up, well over 8% again. Starting to see this number should start to increase significantly as we reach further towards Christmas. And a lot of that has to do with the fact, not necessarily because of the demand side, but because of the service requirements that are about to be incurred. A lot of these freight movements need to, they're going to have a lot more, a lot less time to make their deliveries right now versus when they had earlier in the year. So that's really what's causing a lot of the capacity disruption across the country. So pulling up our brand new weighted rejection index. Anything in blue, those are the markets you need to pay attention to. Anything in red, that's going to be a cooling or softening environment. So looking across the country right now, you see right here around the Northeast a lot of blue, especially around Harrisburg market. Around here, around the Port of New York, New Jersey, a lot of that freight has entered the ports there, still creating a lot of increasing demand. And then you have Columbus right here, Joliet. Some of our more important hub markets have really been expanding over the last couple of days. Retail has really been doing quite robust over the last few weeks. Down here in Ontario, Los Angeles, Pendleton, Oregon, again, starting to heat up again. So let's knock out a few of these markets. So here's the list of where you see the most significant increases in rejection rate or decreasing capacity. So Ontario, Los Angeles, Charlotte, all big hitters over the last week in terms of tightening capacity. Also some of the most relevant markets. If you look at the market share values, 3.4, 2.5, 1.56% total market share. Let's go ahead and look at the outbound rejection index in Ontario as well. So long haul volumes really creating a tightening effect in the rest of the market. So this green line right here, long haul outbound tender volume, along with an 8.04% tender rejection rate. So very tight capacity right now, especially coming out. Long haul volumes tend to be driving that. That means that anybody that's looking for freight moving across the country, but also pay attention to those service requirements. Probably a lot of team freight required here. Next up, we've got the Kansas City market. So Kansas City, one of those darker blue markets in the middle of the country, but it is not a dry van market. It is reefer demand that's driving this one. Down here, you see the van outbound tender rejection index in green, pretty subdued. Up here in the orange, 13.49%, or I should say 35.26% on the outbound reefer rejection rate. So if you are a reefer carrier, middle of the country right now, really tight, especially around Kansas City. And last but not least, I wanted to pull up the Dallas market. This is not one that's, it's not heating up. It's actually cooling down. So this is towards the bottom. This is one of the lowest weighted rejection index values that we've seen. And that's due to the fact that the tender rejection rate has dropped all the way from almost 4.5% way down to 2.52%. So if you are a carrier in this market, you have super soft conditions. Do not look for spot freight in this area. A lot of oversupply situation. Volumes are not really contracting that significantly, but they are coming down. So any carriers in this area need to just be able to get out of this market and make sure that they get a freight movement out of there. And that'll do it for today's Carrier Update.
The comprehensive logistics offerings from Powerfleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with Powerfleet.
Hi everyone, I'm Luke and I'm bringing you your broker update for today, and should be our last full week before Christmas hits, so I hope everybody gets all of your workload done this week, but we're in transportation, so we're always working. We're going to take a look at a handful of different things in the market today. Number one, where to focus some of your sales calls for the day. I'll show you a couple ways to take advantage of the charts for that, and then a few other areas in the Midwestern region of the United States, some cooling offs in those areas of the country. Let's take a look. So behind us, we've got in blue the outbound tender rejection index in the United States. So this is blue line. We saw this big push up here for Thanksgiving. No surprise there, a slight dip. And then we're continuing to push and maintain a pretty healthy level there of a little over 8%. So about 8.2% right now. That's quite significant. We haven't seen a level that high really this year. And not only that, maintain that. Especially as we get closer and closer to Christmas, there's not a lot of time to move that freight, so you're probably going to see that continue to at least hold that level and potentially increase even further. In the green line here, we've got our volume level. So again, kind of a push up to Thanksgiving, a dip, but we've recovered quite significantly from that post-Thanksgiving dip. A number to keep your eye on is we're a little over 10,000, 10,200. Since we began measuring this back in March of 2018, so almost 2 years ago now, the number started out at 10,000. So anytime you see this number above 10,000, that means there is growth. We are higher than where we were from when we started measuring all of this. That's a good sign here. We've gone above that number. We were below that number a few months ago, but we're back up. So that's a good sign here, especially as you continue to see the volume push as there's less time to get that freight moved before Christmas. So make sure you have all of your customers on the phone. There's a lot of freight there to move. All right. Let's take a look at this map here. This is one of our 3D maps. There's two data sets here to keep an eye on. The blue and the red, so the colors represent the 7-day change in head haul index. So basically the blue, the darker the blue means that capacity is beginning to tighten in that market. The darker the red means that capacity is beginning to loosen. So if you're moving freight out of a red market, it means over the last 7 days capacity is loosened. That's in your favor as a broker. So you now have more capacity to source to get your freight moved. In the blue markets, it's the opposite. Over the last 7 days, capacity is tightened, meaning you now have less capacity to pull from in order to move your freight. The height on the chart, so as you continue to see some of these markets elevate, like down here in Atlanta, you see a massive elevation, okay? That is market share. So the higher the market is, that means that market has a lot more outbound volume, okay? So in Atlanta, you're sitting at probably a little over 4%. You can see down there on the scale on the bottom, a little over 4% of the nation's outbound freight comes out of Atlanta. That's important because this is where you can focus on your sales calls for today and this week. Call the markets in blue with a lot of height on them. So focus on Ontario. LA is red, so that means capacity is loosening there. Shippers may not need as much help as typical, even though it is a massive market. There's still plenty of capacity. So you're going to want to call the markets in blue that also have a lot of height. So Ontario, Phoenix, Salt Lake City, Atlanta, areas up here in Ohio and Michigan. Some of those areas there are beginning to see a lot of tightening in capacity, but also have a lot of market share, so there's a lot of demand there. All right, taking a look at some of these areas right here in Michigan and just central Midwestern parts of the United States, we saw a lot of capacity and rejections shoot up last week, but they've come off the cliff. Looking at van outbound tender rejections out of Detroit, we saw this massive spike all the way up here from a little over 4% last week or the week after Thanksgiving, and hit almost about 30%, and we've seen them fall off a cliff. Okay, so that's a perfect indicator. As you see this massive spike here happens, that means that spot market rates are going to go through the roof, and as that falls off, they're going to drop back down. Now, a lot of those markets tend to move together up there. You have all of Michigan, from Detroit and Senegal. You've got Columbus, Ohio, Bloomington, Indianapolis, any of those, Cleveland, all those markets tend to move together. So when you see one spike, you typically see all the others. So that a lot lot of that is due to all the car manufacturers and all those parts shuffling between each other. So if you're moving freight over there, it's a lot softer this week. Shouldn't be as difficult to get your freight moved this week, but you're probably not going to be able to charge the same rates you were charging last week. So just do keep an eye on that. Just to take a look at a couple of the lanes out of Detroit. So we've got some of the highest ones being Detroit to Bloomington, sitting over, still over 12%, so well above the national average. Detroit to Harrisburg, Philadelphia, Chicago, Indianapolis. So a lot of those markets there in the center part of the United States. And that's your broke rate for today. I'm Luke, and enjoy the rest of your week.
Voices from every corner of the supply chain concerning all modes of transportation. From the world's largest logistics podcast network, this is what the Freight Tech Revolution sounds like. Freightcast presented by FreightWaves. Subscribe now wherever you get your podcasts.
I'm Anthony Smith, and I'm here to bring you an econ shipper update. So behind me, I have the ISM Manufacturing Index with our flatbed and van outbound tender rejection indexes. So one of the things when I'm looking at the econ outlook is I like to split it up into two different segments. I like to look at manufacturing, things on the industrial side, then I like to look at things on the consumer side of things. Sometimes there's a slight overlap, but when we're looking at things like the ISM Manufacturing Index, it's really going to give us a forward outlook of what to expect on the industrial side of things, especially when we're looking at manufacturing segments. Behind me, I have the ISM in yellow, and I have our van outbound tender rejections in red, and our flatbed outbound tender rejections in orange. As we can see that there's been a nice, not too nice, but there's been a pretty consistent decline in the ISM Manufacturing Index. So for background, anything under 50 is representative of contraction within the industry. Anything above 50 is representation of expansion. So when we're seeing that contraction in the ISM Manufacturing Index, that's telling us that there is contraction in the industry, that there's fewer manufactured goods to go around the country. And so that's really going to play into the type of freight that usually hauls these goods, especially when we're looking at machinery and things like new orders like that, especially when we get to our next slide. I have manufactured goods on the manufacturing side of things for factories. Let's see here, is it pulling up? Not pulling up right now, but when we're looking at our outbound tender rejections and we're looking at new orders, it's really an expectation of what's on tap to be delivered in the next 2 to 3 months. And so one of the things that we're seeing here is that there's a subtle uptick when we're looking at outbound tender rejections. A lot of this is going to come from the recent holiday spikes and not a lot coming from the manufacturing side, especially when we're looking at our new factory orders. Now, one of the things that is going to be looking to drive improvements is some things coming from the construction spending. Although that did dip down in the most recent month, there is going to be a subtle rise for construction spending going into 2020. There's a lot of pent-up demand. One of the things that we are seeing within the segments of construction spending is a rise for construction spending for the public sector, mostly coming from highway and street construction. So that's really going to be a nice driver of growth when you're looking for flatbed activity, especially if you're looking for flatbed activity within the construction segment. Another thing that's really going to drive growth, not only on the economic side, but really for the freight side, is, as I mentioned earlier, was the consumer. So the consumer activity is really driving the U.S. economy as usual, but it's also compensating for a lot of freight activity as well. And so when we're looking at those two put together, it's really indicative that, we have our new orders here, and we can definitely pull up our non-defense capital goods new orders. And so when we're looking at non-defense capital goods new orders, that's really telling us a nice barometer of business-to-business activity. And so when we're looking at business-to-business activity, that's really giving us an insight to how confident businesses are feeling about the current economic climate. And when they are feeling confident, they're going to start to invest more and more. Now, non-defense capital goods new orders, excluding aircraft, is something that gives us a good idea of how confident businesses are going to pursue new orders going into 2020. I don't expect this to come online anytime in the first month or so, but this is definitely going to be something that we're going to watch closely. That's going to do it for my shipper update and economic update. And it doesn't really just stop here, because we recently launched our FreightWaves TV app, and that's going to have all kinds of content. One of my favorites is going to be my unbiased opinion, the Freightonomics podcast with myself and Zach Strickland. There's also the Great Quarter Guys and also the originals that you love, like What the Truck. Now, that's going to do it for this segment of FreightWaves Now. Be sure to tune in and find us in all your favorite social media outlets. We'll see you on the next episode.
FreightWaves continues to follow the incredibly sad story of Indianapolis-based carrier Celadon Group abruptly shutting its doors, leaving 4,000 people without jobs weeks before Christmas. We here at FreightWaves want to help. FreightWaves has established a free job board for companies to post their openings and for people looking for employment in the freight industry to share their resumes. There's no cost for anyone to participate. Hundreds of jobs have already been added to the site since it went live on Monday. If you're looking for employment or have a job to post, head to freightwaves.careers.